For decades, one quiet flow of money has helped hold the modern financial world together. Not oil, not gold, but something far less visible and far more fragile. A constant stream of capital moving into one place, long-term government debt issued by the United States. It sits there quietly on balance sheets, pension funds, insurance companies, central banks. The kind of asset most people never think about, but almost every financial system depends on in some way. And among the biggest holders of it has been Japan. For years, Japan wasn't just a participant in this system, it was one of its pillars. But something subtle has started shifting. Not a dramatic exit, not a public breakup, not a headline moment, just a gradual, almost careful adjustment in exposure. And the uncomfortable question underneath it is this: what happens when one of the most stable buyers in the world starts to quietly hesitate? To understand why this matters, you have to step back from the headlines and look at how strange the global system actually is. The United States government issues debt to fund itself. That debt is bought by investors around the world. In return, those investors receive something considered extremely safe: United States government bonds issued by the United States Department of the Treasury. But safe doesn't mean unchanging, because the value of holding that debt depends on interest rates, currency movements, and something even more powerful: confidence. And confidence, unlike math, doesn't stay still. For a long time, Japan was almost structurally locked into this system.
Its economy generated large pools of savings. Its institutions needed stable, liquid assets, and global U.S. government bonds were the default parking place for that capital.
But beneath the surface, Japan also carried a contradiction. Its domestic interest rates stayed extremely low for years, sometimes near zero. Meanwhile, global interest rates eventually began to rise. That gap created pressure. Not dramatic at first, more like friction building inside a machine that had run smoothly for decades. And when friction builds in financial systems, it rarely breaks loudly. It shifts quietly. At first, the change shows up in small decisions inside institutions: portfolio adjustments, currency hedging strategies, duration preferences. Nothing that looks like a crisis, but something that signals rethinking. Because holding foreign government debt isn't just about return, it's also about currency risk. If you're a Japanese institution earning in yen, but holding dollar-denominated assets, you're exposed to every move between those currencies. Even if the bond itself is stable, the exchange rate can quietly reshape your returns. And that's where things start to matter more than most people realize. Because currency movements don't just affect profit, they affect certainty. And modern finance is built on certainty. So when uncertainty increases even slightly, the system reacts not with panic, but with recalibration. Meanwhile, another force has been building inside Japan itself. For decades, the country exported savings to the rest of the world. But an aging population changes that equation. More retirees, more domestic obligations, more pressure on institutions to secure stable returns at home rather than abroad, and suddenly, capital that once flowed outward starts to feel more needed internally. Not withdrawn aggressively, just less freely exported. This is where the story stops being about one country's investment choices and starts becoming about global dependency. Because the modern financial system is not a collection of independent actors. It's a network of assumptions.
One of those assumptions has been major foreign buyers will continue absorbing large amounts of U.S. government debt consistently over time.
If that assumption weakens, even slightly, everything else adjusts around it. Not instantly, but steadily. And there is another layer most people miss: interest rates. For years, global central banking operated in an environment where borrowing was unusually cheap. That shaped everything: government spending, corporate expansion, housing markets, even risk-taking behavior. But as inflation pressures forced central banks to respond, rates rose across major economies. Higher yields changed the entire logic of holding older, lower-yielding bonds. If new bonds offer better returns, older holdings lose relative attractiveness. That doesn't mean holders panic. It means they become more selective. And selectivity, at scale, looks like reduced appetite. Now imagine this happening simultaneously across multiple institutions in multiple countries, each adjusting independently for their own rational reasons. No conspiracy, no coordinated decision, just alignment of incentives. And that is often how systemic change actually happens. Quietly, mechanically, without intention. Back in financial markets, people tend to look for dramatic signals. Crashes, defaults, sudden sell-offs. But the real story is often hidden in balance sheets, in small changes to allocation percentages, in central bank commentary that avoids strong commitments, in long-term investors slowly extending hedges or shortening duration. Each move makes sense on its own. Together they start to reshape demand, and demand is what stabilizes debt markets in the first place. The irony is that the more stable something appears, the more invisible its dependencies become. For decades, U.S. government debt has been treated as the deepest, most liquid safe asset in the world. That perception itself reinforces its stability. But perceptions can shift without collapse. They can simply soften, and when they do, the adjustment spreads through pricing, yields, and currency expectations. Inside Japan, financial institutions also face a more immediate constraint that often gets overlooked: domestic yield normalization. After years of ultra-low rates, even small changes in domestic bond yields change the comparison between keeping money at home versus sending it abroad. If domestic assets begin offering more competitive returns with less currency risk, the rational preference shifts inward. Again, nothing emotional, just arithmetic. But when billions or trillions of dollars in global portfolios respond to the same arithmetic, the effects stop being small. They become structural. There is also a psychological layer that rarely gets discussed in economic analysis. For decades, the global system trained investors to assume continuity, that major economies would always support liquidity, that central banks would always intervene when needed, that government debt would always remain the anchor of the system. But after multiple financial shocks over the past 2 decades, that confidence is more cautious now. Not gone, just more conditional. And conditional confidence behaves differently. It doesn't disappear suddenly. It reduces exposure quietly. This is why changes in large reserve holders matter so much. But after multiple financial shocks over the past 2 decades, that confidence is more cautious now. Not gone, just more conditional. And conditional confidence behaves differently. It doesn't disappear suddenly. It reduces exposure quietly. This is why changes in large reserve holders matter so much. They don't need to sell everything for the system to feel it. They only need to stop increasing exposure at the same pace as before, because global debt markets are not just about who sells, they are about who consistently buys. And in that sense, even a slowdown in accumulation can feel like a shift in gravity. For the average person, this might sound distant, but the effects are not, because U.S. government bond yields influence global borrowing costs. They shape mortgage rates, corporate loans, and even equity valuations worldwide. When demand dynamics shift, even slightly, it feeds into those costs. Slowly, indirectly, but persistently. And that is where the human impact becomes visible. A small increase in borrowing costs doesn't sound dramatic on paper, but across households it can mean delayed home ownership. Across businesses, it can mean reduced expansion. Across governments, it can mean tighter fiscal constraints. None of these changes require a crisis, only a rebalancing of expectations. And that brings us back to Japan. What looks like quiet reduction from the outside is better understood as something more precise. Portfolio normalization under changing global conditions. Not exit, not rejection, adjustment, but in a system built on enormous scale and long-term assumptions, even adjustment becomes significant. Because there is no central authority coordinating global capital allocation. There are only millions of decisions made independently, influenced by the same shifting conditions. And when enough of those decisions move in the same direction, the system itself begins to change shape. Not loudly, not visibly at first, but structurally. The deeper truth underneath all of this is uncomfortable. Modern financial stability is not a fixed state. It is an ongoing alignment of incentives between governments that issue debt, institutions that hold it, and currencies that connect them. As long as those incentives remain balanced, the system feels stable. But when one part of that balance shifts, interest rates, demographics, currency dynamics, the entire structure adapts.
Japan's changing relationship with U.S. debt is not the cause of instability.
It is a reflection of a world where the old assumptions are being tested in real time. And perhaps the most important detail is this: nothing here requires panic to matter. No collapse, no shock, no sudden break, only gradual recalibration, the kind that is almost invisible while it is happening, and obvious only in hindsight. And by the time it becomes obvious, the system has already moved on to its next configuration.